Nick, good to see you. Let's talk about how to invest when interest rates are cut. Interest rates have been high since March of 2022, but they are finally coming down. That means it is time to rethink how we are investing. But first, why is the Fed now lowering rates?
Well, because they think that they've got inflation under control. Inflation went up and they raised rates to slow things down. And now they think things are slowed down. So now that's why they're dropping rates. So if you look at this chart that you got there, all those colorful squiggly lines, those are the inflation numbers.
Hmm.
And the black line is the Fed funds rate. So what you'll see is when inflation was going up, all those multiple colored lines, the Fed started hiking up rates. Now, what you'll see is they almost waited a little too long to do it. They should have raised rates sooner. They raised rates a little too late. So the damage had already been done from an inflation standpoint, but then they started raising the rates. And you'll see how as they raise the rates, how inflation starts coming down. And now what they're looking at is, well, inflation is on a downward trend. And so we can start cutting rates now because our raising rate cycle has ended, and now we can start cutting rates because we've got inflation under control, or so they think.
Hmm. Of course, the risk with raising rates is that it pushes the economy into a recession. So when do we know if we have successfully avoided a recession?
So we may not know that for a while,
Right.
because what happens when they do raise rates is I liken it to a cruise ship. I was on a cruise ship a couple years back, and the captain actually said if he stopped the engines, it would take roughly 2 miles for that boat to come to a complete stop. I thought that's crazy, but if you're in a little boat, you can make little moves real quick. But if you're on a big cruise ship and you want to make a turn, that's going to take a long time. So when Fed hikes up interest rates, it takes time for that to trickle down. And now we're starting to see some of the effects of that, because when the Fed hikes up interest rates, the purpose for that is to slow things down, to make money harder to get. So companies, when they want to take loans, they can't get those loans anymore because the interest rates are too high. So then companies don't expand. And so that was the whole intention behind it. Well, everybody's like, oh yeah, the job market's going great and everything's going great and all this stuff. But now we're starting to see new things happen. I've started to hear about layoffs. I started hearing about furloughs. That's a term I hadn't heard for like years. Like it was like COVID when I heard that. So I did an analysis here, and I pulled off an entire list of companies that have laid off employees in 2024. And so here's a couple of them. Paramount. We all watch movies. They laid off 15% of its workforce in September. That's 2,000 people. Career Builder and Monster laid off 15% of its workforce. DocuSign laid off 6% of its workforce. Sonos, the sound company, laid off 6%. Twitch, 33%. Fibrogen, 75% of its U.S. staff laid off. Intel, 15% of its workforce. That's 15,000 jobs. Cisco laid off 4,000 in February and then another 5,600 in August. Microsoft laid off 8% of its workforce. That's 1,900 people. eBay, 9% of its workforce. That's 1,000 jobs. Citi, I only got 3 more left. Citi, 20,000 cuts at Citi. UPS, 12,000. Nike, they've already had 2 rounds of layoffs, Nike. And now we've heard Boeing is going to lay off 17,000 people, and Spirit Airlines furloughed 700 people. So all this starts coming around. And so where this ends up happening is this is the chart here. This is the expectation of what rates are going to be in the future. And so each of these dots represents a different Fed person's opinion on what they want the interest rates to be, what they want the federal funds rate to be. And the orange dots are kind of like the consensus of what the agreement is. And so you'll see 2024, the rate where it is. And then you're going to see in 2025 how the rate is going to come down. In 2026, how it comes down even more, and how the long run picture is to have the rates under 3%. So I drew this green line on this to help kind of show you that we're at the peak right now. The rates had gone all the way up at the top of this mountain peak. This is where we're at the peak of this mountain. And now we're starting to come down this mountain peak. And it's going to start affecting people because a lot of people are dependent on these new higher interest rates. these 4% and 5% rates, that now it's going to affect them. But that is the long-term picture. That's the expectation of what the Fed wants to do, is they want to start cutting these rates down.
Mm-hmm. So now let's talk about investing them when those rates are on the decline. What's the biggest difference?
Well, we go back to rates like 2020 and 2021, when the only interest that you earned was you went to the bank and you got a bottle of water. Of course, in 2020, we didn't want to go to the bank, right? Everybody had cooties. But I mean, interest was a bottle of water. So, checking and savings accounts paid next to nothing. Remember, CDs were like 1.5%, 2%, not the 5% that we've been getting. Money market accounts were 2 to 3% instead of 5% that we've been getting. And so, like I was saying earlier, this might cut the amount of income that you're getting from your expenses or from your investments. This might cut the income that you're getting from your CDs, your money markets, your checking and savings accounts. It could affect your lifestyle. You'll have to change maybe how you invest. CDs will return from where they are now to being certificates of depreciation, which is just a kind of a funny term used. But that actually came out in the late 80s, that term. Because in the early 80s, CDs were paying double digits. And then the same thing happened in the 80s that's happening now. CD rates started dropping. And everybody started saying, those CDs aren't paying anything anymore. They are just like certificates of depreciation. And that's kind of or certificate of disappointment. You could call it whatever you want. Mm-hmm. So what's the big difference is, to keep up with inflation, people are going to have to go elsewhere. The investment strategy that you've used for the last 2 years is going to have to change.
Right. So let's talk about that then. What specific investment should we be considering right now in this environment?
Well, number one, rates haven't dropped off the cliff yet. They've kind of inched down just a little bit. So this just tells us, and like that chart, that Fed dot plot chart, it shows you what the expectation is coming up in the future and what they intend for it to do. So here's one tip. Don't renew for a short-term 5% when you can lock in 5% for something longer. Because if you just say, you know what, I'm just going to renew that 5% CD for 7 months. Well, in 7 months when rates are really down and you try and renew that CD, you're not going to be able to get much. So you may as well try and lock in these higher rates at these rates right now. You may as well try and lock these rates in for a much longer period of time. You know, if you can get 5% for 5 years, that's going to be a heck of a lot better than getting 5% for 7 months, because at least you locked in those better rates. Tip number two, look at your annuities if you have them. Some people have annuities that provide an income, and you might be able to upgrade those annuities. That's almost like refinancing. If you think about the house that you live in, we like houses, and it's not that we're moving out of the house, but when interest rates drop, we refinance because we want a cheaper rate. The same thing can happen with annuities. If you have annuities, you might be able to upgrade those, lock in maybe better return potential, or maybe better income. I've even seen some of these where some of the lifetime income that people can get today on the same dollar is maybe 20, 30, or 40% higher than their current plan, all because they're locking in today's rates versus the rates that they had when they originally set up those plans. So there's a couple tips. Now, the third tip that I'm going to say is when interest rates drop, it typically is good for the stock market because it pushes people into the stock market. You can't earn anything in CDs anymore. I can't earn anything anymore over there. So where am I going to have to go? I'm going to have to go in the stock market. One place people will go is maybe high yield investments in the stock market. Certain alternative investments are things that can fit here. These are things that can maybe provide great income. You might be able to get a 6 or a 7 or an 8% interest or dividend. And the only risk that you have is if the stock market goes down maybe 20 or 30%. So you have usually a barrier to the downside. And some of these things you can get through major banks. There's different types of these alternative strategies. Structured notes or structured income notes can be a great alternative to try and get better rates of return in a world where we're going to be going back, Aaron, to I think a point in time where we're saying, again, like I said 5 years ago, I can remember being interviewed on TV and saying 5 years ago that the whole goal is to try and get 5% in a 1% world. And that's where we're heading. Right now, we're in a 5% world, but we're heading back to that lower interest world. And when that happens, you need to start changing your investment strategy, looking at alternative strategies that can pay better rates of return. But at least for now, while there's an opportunity, look to try and upgrade the plans that you have to lock in these better rates while it's still there, because it's going to fall off a cliff and you just don't want to look backwards and say, dang, I shoulda, woulda, coulda.
Yeah, now is the time. All right, Nick, if somebody has more questions about how they should be invested and whether they are prepared for a lower interest rate environment, what's the best way to reach you?
The best way is just to schedule a 15-minute strategy session call. Very simple, that we can get your questions answered and help you figure out if you are at risk or not at risk. And you can just schedule that by going to our website, group10financial.com. There's a link right on there where you can get right on our virtual calendar and schedule that. And of course, if you don't do that type of thing, it's like, I don't do virtual calendars, Nick. I don't do any of that. I'm old school. I'm yellow pad. Like my dad, he loves the yellow pad. So if that's you, you can always give us a call at 844 Group 10. Our team here can schedule that quick 15-minute call so that you can get your questions answered. See what opportunities are out there while there's still an opportunity to do something about things.
Great. All right. Timely conversation. Nick, thank you so much.
Great being with you as always.